I think at that moment when I was describing the tax burden by buyer and seller with different elasticity of demand and supply, I think at that moment the connection was not lost. I'm just going to repeat this thing here. Just going to summarize this thing here. We have seen that. There are two types of supply curve depends upon the elasticity. One is more elastic, other is less elastic. When the supply curve becomes less elastic, that is from SS to that is S1. S1, we have seen that the effect is that there is a less increase in price, but the burden shared by seller increases. Okay, and in another diagram, when we change the elasticity of demand, then we find that DD is more elastic than D1. D1, when the demand curve becomes less elastic, then the consequence is there is more increase in price, and the burden shared by buyer increase. And in the next diagram, here, so this is the demand curve. Initial supply curve is here without imposition of the unit tax here. So initial equilibrium when market clears at point A, so the market price is OB, buyer is paying OB, and seller is receiving OB, and the equilibrium output is OC. Now, with the imposition of the unit tax, that is U, the supply curve shifting parallelly leftward here, and the new equilibrium is at point G here now, and what is happening that now price increase from OB to OF, so and quantity decrease from OC to OE. So ultimately what is happening, earlier buyer was paying OB and seller was receiving OB, there was no way. But after the imposition of tax, now buyer is paying OF. So that is the burden shared by the buyer. That is the burden shared by the buyer, GH, out of this tax, and what seller is receiving ultimately, effectively. So this the buyer is paying this much OF, that is a GE, and out of this that this part GL will go to the government at the part of tax, and the seller is receiving ultimately OK. So this rectangle area is the government revenue, and buyer now paying OF, seller receiving OK. Earlier buyer was paying OB, seller was also receiving OB. So this is the burden HL shared by the seller, and how much the burden will be shared by buyer and seller, that depends upon the elasticity of demand and elasticity of supply. That's it. That was the in the last chapter. Now we are entering into the unit 4 of part A, that is about government and fiscal policy. And here there are two tools, that is the fiscal policy and monetary policy. Fiscal policy, that is it includes government expenditure and tax. There are two tools related with the fiscal policy, that is government expenditure and tax. And there is another policy, that is a monetary policy, which is regulated by central bank. And about the monetary policy, that we will do in the next chapter. But in this chapter we will do something about the fiscal policy, the effect of increasing government or decreasing government expenditure, how it affects the economy, how it affects the national income of the economy, and the effect of the change of the tax on the again on the economy in terms of the national income. Now here I think in macroeconomics you have done a lot of things about it. So here now first is there are some terms here that government purchase, net tax, and disposable income. And government purchase, that is the government expenditure basically, and net tax, that is the tax imposed by the government. And by imposing the tax, the government collects tax revenue from the economy, and at the same time government transfers some income to the person. So net tax is just the tax minus transfer payment, that is the net accumulation of the revenue, net collection of the revenue by the government. That is a net tax. And disposable income is the income that is after the tax, that you know. Okay, and here we are considering the case of the lump sum tax. That what is lump sum tax? Lump sum tax that is independent of the level of income. It is not like the progressive tax. That is the rate tax rate change with the level of income. It is about the lump sum tax, and the fixed amount of tax revenue has been collected. So this is the case. The very simple scenario here. Now, with this thing, so we can say if y, so in macroeconomics we say about the aggregate income, aggregate expenditure. So that is the total income of the economy if it is represented by y here, and net tax, that is the tax minus transfer payment, that is the net tax. So ultimately the disposable income of the consumer, the person, is yd equal to y minus t, that is the disposable income of the household. And 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 and, and how the this disposable income, the household spends on the consumption, and some part as the saving. So this disposable income is basically is the sum of consumption and saving of the household. So some part of the disposable income goes for the consumption expenditure, and the remaining part left as the saving, and that is the sum of consumption expenditure and saving done by household is a disposable income. Or in another way, we know that since disposable income is the difference of total income and the net tax, so we can rewrite this equation, and we can again rewrite this equation. Just t को अगर इधर ले आएंगे, then income of the economy will become equal to the consumption expenditure by the household, saving by the household, plus the net tax of the government. Here. So that is the case here. Y is equal to C plus S plus T. Now in this diagram, you can see here flow chart that there are the three agents here. Actually, we are talking about the three economy, three sector model basically. That is the consumption sector, investment sector, and government expenditure sector. The mirror image is the consumption, saving, and tax. So there are three agents here for household and government here. Now what is happening, the household are supplying land, labor, capital, and getting some income from here, aggregate income, that is aggregate income y, and out of this aggregate income, net tax paid to the government, and again government transfers some transfer payment. So net tax we are considering here. So out of this aggregate income, net tax as to the government, so disposable income to the household is y minus t. Now out of this disposable income, what the household is doing, household is spending this disposable income on the consumption expenditure C, and left as the saving. Now this saving through the financial market, I mean through the bank, through bank channel, through other financial market, now it goes for the investment purpose to the farm. Okay, and that is the planned investment by the farm. And what the government is doing, government is collecting revenue from here and spending government expenditure, purchase of goods and services here. So aggregate expenditure of the economy basically is the consumption by the household. I mean, farm is also the part of the household, consumption and investment and government expenditure. So and this is the the aggregate expenditure on the aggregate output. So basically, in one way, we have derived that total output, I mean total income basically here, which is the sum of consumption, saving, and net tax. And similarly, here the expenditure, that is the consumption expenditure, investment expenditure, and government expenditure. That is the from the expenditure point of view, and that is the budget deficit. Budget deficit is the gap of government expenditure and the net tax. If government expenditure exceeds the tax revenue, then that is the case of the budget deficit, and government has to borrow. and in government, the expenditure less than the net tax, then it means the budget surplus. We can say negative budget deficit. But here, so there are two things here we have done, that total income is a sum of consumption, saving, and net tax, and on the other hand, the aggregate expenditure is the sum of consumption expenditure, investment expenditure, and government expenditure. Now we are going to do something with every component. First, we talking about the consumption expenditure, how the consumption expenditure behaves or responds with the level of the income. Consumption expenditure is basically this equation A plus BY, that is the consumption function basically. A is the autonomous consumption expenditure. Autonomous consumption expenditure is the expenditure when Y becomes zero. What would be the consumption expenditure of the person of the household? That becomes equal to A. And B says the responsiveness of the consumption expenditure with the change of the income. I mean, how much the consumption expenditure will change with the change of the level of the income. That is the B. It is also called marginal propensity to consume. That is the change in consumption expenditure with the change of the level of income. That is the marginal propensity to consume. That is B here. Now, actually, we have seen that C is equal to A plus BY. Basically, the consumption expenditure is not depending on total income, because it is after all the disposable income which decides the consumption expenditure, right? So, so total income Y, and out of Y, aggregate income, some tax, household has to pay some tax to the government and receive some transfer payment, that is a net tax from the government. So ultimately, that is the disposable income YD which decides the consumption expenditure. So basically, we can say that consumption expenditure is A plus B Y D, that is disposable income, and disposable income is Y minus T, that is the net tax. So basically, that is the Y minus T here, which is that affecting the consumption expenditure here. And the important thing is here, that is the B. B is the marginal propensity to consume, which says about how much the consumption expenditure will change with the change of the level of the income. Now, one component in the aggregate expenditure, one component was the C plus I plus Z, and so C depends upon the level of income here, and positively depending upon the level of income here. Another is the component is the investment, planned investment. And for simplicity, again, we are considering that, of course, the investment depends upon the rate of interest, because the rate of interest, the opportunity cost, the cost for the investment. But here, for simplicity, we have assumed the investment is autonomous. Autonomous means that it is not sensitive to the interest rate, and for one moment that is fixed. So that is the planned investment. And government expenditure is also considered to be the autonomous. It is not responsive to here. Government expenditure, change in government expenditure can change the Y, but change in Y is not affecting the government expenditure. That's it. That's the thing. So for simplicity, we are doing all these things. So now we have to determine the equilibrium level of output. So on the one hand, we have the knowledge of the total income, which becomes the sum of consumption, saving, and tax. Okay. On the other hand, the that income has to be spent by the economic agent. The expenditure is income side is C plus S plus T, and on the expenditure side is the C plus I plus G. So for equilibrium, this income, whatever the output has been generated, that should be equal to the aggregate expenditure. That's the concept here, the determination of the equilibrium level of output. So Y should be equal to aggregate expenditure, and aggregate expenditure is the sum of consumption expenditure, investment expenditure, and government expenditure. If Y exceeds this aggregate expenditure, then there will be actually the unplanned increase in inventories. There will be increase in inventories, and it will affect decrease in investment basically. And if Y is less than aggregate expenditure, then it means that there is a decrease in the inventories, and increase it will raise the output. Inventory will decline, investment will increase, and output will increase. So Y is equal to C plus I plus Z. This is the equilibrium stage for the equilibrium, where total income of the economy, total output of the economy, we can say in terms of the output, becomes equal to the expenditure by here three consumption, in terms of consumption, in terms of investment expenditure, in terms of the government expenditure. In another way, we can say the total output has been generated here Y, and out of Y some part goes for the consumption expenditure, some output has been used as the investment expenditure, and some output has been used as the government expenditure. So basically this is the thing here for the equilibrium level of output. Now one numerical thing here. So we have just we are now acquainted with the consumption function, that is C becomes equal to A plus BY. Now let's say consumption function is like that: 100 plus 0.75 YD. YD is a disposable income. And what is 100? 100 is the autonomous consumption. When in disposable income is 0, then consumption will be 100. And what about the 0.75? 0.75 is here marginal propensity to consume, MPC. And so 0.75 represent that if disposable income increase by 1 rupee, then the consumption expenditure will also increase by 0.75 rupee. That's it. That's the MPC. Responsiveness measures the responsiveness, the change in consumption expenditure with the change of the level of the income. So that is the again we can rewrite this equation here. Now suppose that we हमने कहा कि government expenditure we are considering, we are assuming the autonomous, that is fixed for the moment. Fixed in the sense that it is not depending on any other thing like that consumption. So in consumption, investment and government expenditure, only consumption जो है, that is not autonomous, that is depending upon something. Investment we have assumed autonomous, and government expenditure also assuming autonomous, that is not depending upon any variable here. So government is 100, expenditure is 100, and planned investment expenditure that is here, which is also 100, and net tax that is a tax minus transfer payment, that is also 100, and tax is also again the lump sum tax, which is again not depending upon any other variable. That is a fixed amount of the tax revenue. So that is a very simple type of the model here. So we have the the consumption function, we have the investment expenditure amount, we have the government expenditure amount, and we have the net tax amount. So with this information, we have to find out the equilibrium level of income. So what you will do? Numerically, जो है, for equilibrium you know that Y should be equal to C plus I plus Z. So what you will do, that C is this, okay, 100 plus 0.75 Y minus T plus I plus Z. I is 100, G is also 100, T is also 100, and so only one variable Y which is unknown in this equation. So you can find out, just calculate the Y. And in the next table, we can say that how we will reach the equilibrium point. With all this information, basically, if you just equate Y is equal to C plus I plus Z and put all the value, you will get Y should be equal to 900. And when Y becomes equal to 900, it becomes equal to C plus I plus Z, that is 900 also. What will happen that if Y is not 900, let's say 300. So if Y is 300, net tax, that is fixed 100. So disposable income is Y minus T, that is a 200, And once we know the disposable income, that is 200, we can find out the consumption expenditure. Consumption expenditure, 100 minus 0.75 into YD, disposable income is 200, just put here 250. And you can find out the saving, that is this saving basically minus 1500. Investment we have given, that is 100. Government expenditure also we have given the 100. So just add consumption expenditure plus investment expenditure plus government expenditure, that is the aggregate expenditure, 450. So aggregate expenditure, planned aggregate expenditure exceeds the level of income. So what will happen? There will be a decrease in the inventory. Investment will increase and output will increase. Now, in the second stage, as the output has increased, now the income output has increased to 500. Now, at this 500, but tax is fixed here now, but disposable income has changed 400. With this 400, consumption expenditure is here, and 400, that is also 400. And investment is 100 again, government expenditure 100 again, and expenditure is 600. But again, the Y is not equal to C plus I plus G. In fact, the aggregate expenditure exceeds the Y. So what will happen? Again, there is a decrease in the unplanned inventory, and the investment will increase, output will increase. Let's say output increased to 700. Now at 700, now disposable income is 600. With this disposable income, consumption is 550. So 100 per 550 plus 100 plus 100, that is 750. So again, the aggregate expenditure exceeds by 50 and output increase. Now at 900, the disposable income is 800. With this disposable income 800, consumption expenditure is 700, and now investment is 100, government expenditure is 100, so aggregate expenditure also 100. So here Y becomes equal to aggregate expenditure, no change in the inventory, that is the equivalent case. Now what will happen if the Y exceeds the aggregate expenditure? Now let's say the 1100. At 1100, so disposable income is 1000. So here, so there will be consumption expenditure, that is 850, and 100, 1050. So here Y exceeds the, that is 1100 Y, and aggregate expenditure 1050. So जो भी output है, that is not being spent here. It means that what? It means that inventory will increase, investment will decrease, and output will decrease. So again, at let's say at 1500, disposable income is 1400, and consumption expenditure with this disposable income 1150. So investment add 100, 1350. Again, the expenditure less than the output of the economy. So the inventory will increase, investment will decrease, and output will decrease. Now, so we can find out, we can calculate the equilibrium level of income, and you can just equate Y is equal to C plus I plus Z, put all the values, you will get the Y is equal to 900. So this diagram represents this thing here. So okay, so here, this line represents the aggregate expenditure. Here, see, on the vertical axis, there is the planned aggregate expenditure. On the horizontal axis, Y. And you can see that 145-degree line, this is the 45-degree line. You know that 45-degree line equally divide into this area. Here, this becomes vertical axis becomes equal to horizontal axis at every point. Okay. Now, from here, consumption function is the 100 plus 0.755 minus T. So with different, Y and disposable income, we can find the consumption line. When disposable income is 0, the consumption is here somewhere. Then consumption increase with the increase of the level of the income, and this is the consumption line. And now we add in this consumption to the investment, plus investment was 100, government expenditure was 100, so that is I plus G is equal to 200. So we add 200 here, and we find aggregate expenditure line, that is C plus I plus G. And now we can see that this C plus I plus G is intersecting this 45-degree line at this point, and you know that 45-degree line represents at every point on the 45-degree line vertical axis, the distance from origin to vertical becomes equal to the distance from origin to the horizontal. So that becomes at 900 जो अभी calculate किए. That is the case. You can draw the diagram that with the consumption line, aggregate expenditure line, and the equilibrium is here when y becomes equal to aggregate expenditure, which is at 900. Aggregate income y is 900 here. So now we can also find, see, that is the income aggregate expenditure approach. Through the saving investment expenditure approach, we can also find the equilibrium case. What will happen that when y becomes equal to c plus I plus z, that is the aggregate expenditure. And what is y? Y is the sum of c plus s, c and s and t. So c plus s plus t becomes equal to c plus I plus z. So cc will be cancelled. Ultimately, that is the sum of saving and tax, net tax, becomes equal to investment and government expenditure. That is again the equilibrium case. That is again the equilibrium case. And when government expenditure becomes equal to the net tax, that is a balanced government budget, then saving becomes equal to investment. Okay. So otherwise, saving will not be equal to investment, but it is the sum of saving and net tax which becomes equal to the sum of investment and government expenditure at the equilibrium level of the income. Now we are going to see how the fiscal policy works. Fiscal policy, that is there are two tools, that is the government expenditure and tax. If the government expenditure increase or decrease, or there is a change in government expenditure, how it will affect the national income of the economy. And we will see that there is the multiplier effect. If the government is spending increase, let's say by 100 crore rupees, then national income will change not by 100 crore rupees, but just by some different multiples. So there we can see the multiplier effect. So there are three things we will see here: government spending multiplier, tax multiplier, and balanced budget multiplier. Here in government spending multiplier, let's say I'm just going to put one example that if government wants to, suppose that construct a highway, okay, and government spend, let's say 100 crore rupees, okay. So what the government will do? Government is going to purchase the raw materials for the highway, okay, and hiring the workers, giving the wage. And as the government, let's say government is buying cement from a cement factory, okay, and government is paying something to the cement factory, okay. Now what will happen that owner of the cement factory, income of the owner of cement factory has increased by that amount that is that the owner got by, received by government. Now what will this owner will do? This owner जो change किया income, out of the increase of this income, owner can spend for consumption expenditure and some part for the saving. Okay. Now as this owner is going to use this increase in income some part for the consumption expenditure, let's say owner is buying something again, so जो भी वो buy कर रहा, जिससे वो buy कर रहा, उसका level of income increase करिए. Now जिसका income किया increase किया, again he or she going to raise the consumption expenditure. So ultimately what is happening that government has spent it one time, that is 100 crore, but there is a multiplier effect in the economy. Okay, and through this multiplier effect, let's say just assume that government had bought something, the raw materials for constructing highway at from one factory, let's say for simplicity, and government paid 100 crore rupees to the owner. Now if marginal propensity to consume is 0.75, what does it mean? जितना owner का level of income increase किया, out of this 75% will go for the consumption expenditure. That is the assumption. Okay. Now if now owner of the cement factory is increased, I mean income has increased by 100 crore rupees, that is received by government. So out of this 100 crore rupees, so 75 crore rupees will go for the consumption expenditure. Now suppose that owner had purchased some things of worth 75 crore rupees. जहाँ से purchase किया, now उसका 75 crore rupees income has increased by 75 crore rupees. Now जिसका 75 crore increase किया, now again what will they will do? He or she will increase the consumption expenditure. That consumption expenditure again 75% of the 75. Okay. Then again, so this chain will go on. So ultimately, what is happening? Government has purchased something, the cement from the cement factory, 100 crore rupees. The income of the cement factory has increased by 100 crore rupees. Now the cement factory owner spent this 75 crore rupees out of this 100 crore rupees. The जहाँ से purchase किया, उसका 75 crore rupees increase किया. Now again, that person is spending that 75% of the 75 crore rupees. Then another person of this income has increased. So that is the multiplied effect. The government expenditure multiplied effect. So government has initially bought 100 crore rupees worth of something, but the change in income is something different. And what would be the multiplied? How much the income will change with the change of the government expenditure? Government expenditure, that is, we can calculate by marginal propensity to consume. One thing is that margin, here you can see that 1 by MPS, that is the marginal propensity to save. Marginal propensity to save is just the 1 minus MPC. Why it is like that? It is like that if the 1 rupee, suppose that the income is increased by 1 rupee, and out of this, if the MPC is 0.5, marginal propensity to consume is 0.75. So out of this increase of the 1 rupee, 75 paise will go for the consumption expenditure. So left is saving, that is 25. So MPS, that is the marginal propensity to save, is just the 1 minus MPC, or we can say MPC plus MPS becomes equal to 1. And so government expenditure multiplied is 1 upon MPS. What will happen in our case? In our case, the MPC was 0.75, right? So what would be the MPS? MPS will be 0.25. 1 minus 0.75, that's 0.25. So we put here 1 upon 0.25, that will become equal to 4. So multiplied is 4. What does it mean? That any change in the government expenditure will change the national income by 4 times if the MPC is 0.75. That is the case. If government expenditure increased by 50 crore, let's say, then increased by 50 crore, then national income will increase by 200 crore. That is the thing. I mean, output will increase by 200 crore. Value, I mean, in real sense, we can say. So that is the government expenditure multiplier, and we can see in the table here. We can see in the table here. Earlier, if you remember that जो table देखे, there was government expenditure was 100. Now government expenditure 150. Now again it is fixed. It is not changing with the another, not depending on other variable, any variable. And investment is same 100. Same consumption function, 100 minus 0.75 YD. So only what we have done, we have changed the government expenditure. We have raised the government expenditure by 50. Earlier it was 100. Now it is 150. So how it will affect the equilibrium level of output? Earlier that was 900. Remember. So earlier the equilibrium level of output was 900. At the 900 there was Y becomes equal to aggregate expenditure. But now when Y is 900, disposable income is 800. With this disposable income, consumption expenditure is 700. Now investment is 100, but government expenditure 150. So aggregate expenditure exceeds the Y output. So what will happen? The decrease in the inventory, investment will increase, output will increase. And so if it 1100, so if the income is 1100, at this point the disposable income net, because net tax is 100, disposable income is 1000. With this disposable income, the consumption expenditure is 850, and planned investment expenditure 100 plus 150. Now it becomes 1100. So Y, that is the output, becomes equal to the aggregate expenditure here, 1100. So you can see that earlier the equivalent level of income was 900. Now equivalent level of income is 1100. That is increased by 200 with the increase of the government expenditure from 100 to 150, that is by 50. So national income increased by 4 times. You can see here with the diagram also that again that is a 45-degree line. Now earlier initially earlier aggregate expenditure line is this. Now we have in this diagram there is no consumption line, just the aggregate expenditure line. So C plus I plus G1, that was the initial aggregate expenditure when government expenditure was 100. Now government expenditure increased by 50, that the gap is 50, that it will shift parallelly. Now the aggregate expenditure increased, and now the new equilibrium point where it intersects at the 45-degree line. At this point, now the new equilibrium level of income is 1100. So earlier it was here equilibrium level of income at 900. At 900, why? Aggregate expenditure was 900. Now with the increase of government expenditure by 50, income increased by 1100 and expenditure also at 1100. So new equilibrium level of income, so income increased by 200. So here the multiplier works in the case of the government expenditure through the change, because this MPC, and higher the marginal propensity to consume, higher will be the multiplier. Okay, because the most part of the the increase in income is going for the consumption expenditure. As the most part of the income will go for the consumption expenditure, then the income of the other person is also increased. They will also again, so this chain will go on and multiplied is increased. Now again we can just think like that. Here the MPC is 0.75. Now just so MPS is 0.25, so we have the multiplier of 4. Government expenditure multiplied is 4. But if MPC is 0.80, it means that now 80% of the increase of the income will go for the consumption expenditure. Okay. So what will be the MPS, marginal propensity to save? That is 1 minus 0.80, that is 0.20. So the multiplier will be 5. Now the income will increase by 5 times with the government expenditure. So that is the government expenditure multiplier, and this is the mechanism how the government expenditure multiplier works. And so there are two tools for the fiscal policy, that is government expenditure, and another is tax. Increasing tax has just the negative factor on the level of income, because it will affect the disposable income, decrease the disposable income, and increase in the tax. And we are talking about the lump sum tax. We are talking about some fixed amount of tax. If this tax has been raised by the government, net tax we are talking about, then what will happen? It will decrease the disposable income. Decrease in disposable income will lead to decrease in consumption expenditure. The decrease in consumption expenditure will lead to decrease in the aggregate expenditure. So tax multiplier works in the opposite direction here. And tax multiplier basically is how much the output will change, or the income will change with the tax, with change of the tax. That is the change in Y, that is initial increase in aggregate expenditure into 1 upon MPS. What is mean of the initial increase in aggregate expenditure? Basically, how much the aggregate expenditure will change with the change of the tax, and that is delta T into MPC. Why it is like that? Because you know that the change in tax is going to affect the aggregate expenditure only through the consumption expenditure. If you see in this equation, where was it? Okay, if you see this equation, C is equal to 100 plus 0.75 Y minus T. Now, if T is changed, now suppose that T plus delta T here, so consumption will change by that is the minus, that is the minus sign, minus delta T into that MPC. That is that will change the consumption expenditure. So that's it. That's the thing. So change in tax, because the tax is only, consumption is only the function of tax in aggregate expenditure. Investment is autonomous. Government expenditure is autonomous. Remember that. So consumption is in the consumption function only the tax is here. So any change in tax will change the consumption expenditure through this marginal propensity to consume. So that's why Now, how much there will be change in the aggregate expenditure, that is through the consumption expenditure, and how much the consumption expenditure will change, that is the thing. So with the change of the tax, we can say how much the income will change, that is the thing. And we can rewrite that change in y due to change in tax, which is the tax multiplier, is the ratio of marginal propensity to consume and marginal propensity to save. In our case, marginal propensity to consume is 0.75, and so a marginal propensity to save will be 0.25. Just divide, you will get 3. So government expenditure multiplier with this MPC 0.75, 4. Tax multiplier is 3. Tax multiplier always less than the government expenditure multiplier. Is basically by 1 unit. Here, so tax multiplier, so how much the output will change? I mean, with the change of the tax, that is by 3 times. If the tax increase by 100, the output will shrink, output will contract, output will decrease by 300. That is the tax multiplier. And the last thing, that is the balanced budget multiplier. Balanced budget multiplier is if government expenditure, there is budget deficit is 0, we can say. That is G minus T becomes equal to 0. It means what? It means that the net tax received by government becomes equal to government expenditure. If the net tax received by government, collected by government is 100 crore, that the government expenditure done by government is 100 crore. So what will happen if the government collected net tax 100 crore and spent this 100 crore in the economy? So if whether it will affect the national income or not. In the in the first instance, it looks like that the same amount of money that the government has taken away from the economy, that is 100 crore, government is again pumping 100 crore in the economy. So how it will affect the economy? But it will affect the economy. It will affect the economy through the multiplier. We have just seen that government expenditure multiplier is greater than the tax multiplier. Okay. And in our case, government expenditure multiplier is 4, tax multiplier is 3. So ultimately the income will increase by the amount of the government purchase. So balanced budget multiplier is 1, basically we can say. That is the case here. And or we can find out the balanced budget multiplier, because government expenditure multiplier is 1 upon MPS, and tax multiplier we have just find out, that is the ratio of marginal propensity to consume and marginal propensity to save, of course negative. And if we add, then we find 1, that is the balanced budget multiplier. So if government collect the net tax 100 crore, spends this 100 crore, then national income will increase by 100 crore. That's the balanced budget multiplier. That's all about the fiscal policy. In the next class, we will do about the monetary policy. Okay, I will save today the previous year question paper and some assignment.